Welcome to a new Smart Money video, and today I would like to share on dividend investing, or how to generate a passive income from dividend shares from start to finish. So if you want to know about dividend investing, how it works, how to get started, what are some of the risks as well as the benefits of this style investing, then this video is for you. We're also going to look at some examples. So if you've wondered what sort of returns can you get, we're going to take the statistical averages over time and apply them to a 10,000 lump sum so that you can see what would this be worth 10 years from now as well as next year. Please do subscribe to the channel if you like getting videos on investing, personal growth, business and finance. We're going to look at what is a dividend. We will then move on to a strategy or some criteria for selecting dividend stocks to ensure we are choosing the very best, as well as what to watch out for when choosing a stock that is giving good dividends but perhaps is false or bad in some way. We will then go on to an example using Apple as that example, which is quite a popular stock and has paid good dividends over the years, but is it really still that great? And lastly, we will finish off with some of the risks of dividend investing and what you should watch out for. What is a dividend? A dividend is when a company generates profits and it takes some of those profits and pays it out to the shareholders. In other words, for a dividend to happen, a company needs to make a profit. In fact, it is illegal for directors to pay dividends out if a company is making losses. And this is why in a number of economic circumstances, you might find that some companies stop paying dividends. And the reason for that is either to conserve cash so that they're able to get through any sort of recession, or they actually didn't make a profit or don't think they will make a profit. And therefore, they don't pay dividends and they wait and hold out to ensure that the company survives first and the dividends are paid out second. These dividends can be paid out quarterly, half-yearly, or annually. What that means is that you might be able to get a little bit of income or a lot, depending how much is invested, each quarter or half a year or year. It does not pay out monthly. So if you're looking for a monthly income source, then it would be better to rather do something else or take the quarter or annual dividends and divide by 12, save it up, and then spend a little each month. An important concept when it comes to dividend investing is something called the dividend yield. And what a dividend yield is the amount of money that's paid in proportion to the share price. For example, if a share was $100 and the dividend per share was $1, then the yield or the dividend yield would be 1%. If you're enjoying this so far, please remember to hit that like button. We're now going to move on to how to select a dividend share, as well as the example of using Apple. And finally, we will close the video off with some risks of dividend investing that you should really avoid. So what are the criteria for choosing a dividend paying stock? Now, the first thing is you need to make sure that it is low volatility. In other words, when you look at the price over time, it is fairly consistent. It doesn't have wild swings up or down. And the wild swings is called volatility. It is very volatile. It is very up and down. Whereas if it's consistent, then there is a low volatility. You can probably eyeball that, but it might pay for you just to spend a little bit of time studying this concept in depth, as it will help you to select better dividend shares. The second criteria when selecting a dividend paying share is to look at the cash flow of the company. This is incredibly important because any healthy company needs not only to generate sales, but also have strong cash flow. In other words, have a good ratio of the sales coming in, the costs going out. That's really important. That cash flow ensures the company will continue into the future, and it won't need any other loans in order to get there. The next thing to look out for is a low debt to equity ratio. Ideally, you want this ratio to be under 1. This means that the company has more equity than it does debt. If the ratio is above 1, it means it has more debt than equity. Now here's something interesting. In our example of Apple that we're looking at, The debt to equity ratio is now 1.2. That's something to think about. If you look at this chart, you can actually see the debt to equity ratio for Apple has increased over time. And that means that it is getting more and more into debt, and it's not generating as much revenue and profits as it was before. So that's something to consider about Apple. Next thing to consider is the payout ratio. And this is really a simple calculation where you take the dividend paid per share, say $1, and you divide it by the earnings per share, which is the amount of money earned per share price. And that's say $2. That means 1 divided by 2, so you'd have 50%. Ideally, this ratio should be less than 55%. In other words, half of the money that the company is earning, it's keeping, and the other half it is paying out. So ideally less than 50% is a payout ratio. If you see something above 50 to say 75%, that is considered very high. So a rule of thumb is if you're paying out more than half of your earnings to your shareholders, you're probably not investing enough into the future of the company to make it sustainable. That should be a warning flag. Apple's payout ratio at the moment sits around 25%. In other words, it takes 1/4 of what it's earned and it distributes it to its shareholders, and the other 3/4 it retains and invests back into the business for its future success. The next thing to check and ask, is the sector that the company is in growing, stagnant, or declining? Now, Apple is in IT and entertainment these days, and if you look at those sectors, they both are growing strong. That means that Apple is within sectors that are growing well and have a good future. In other words, a rising tide makes all the boats float, so Apple can therefore have a chance of winning. If Apple was the only share or company performing in its sector, I would be very worried to invest it because it means it's going against the trend. Two more things to consider on your strategy for dividend investing and selecting stocks. The first one is to narrow your search down. It is quite easy just to look in the S&P 100, so not the S&P 500, but the S&P 100. Often this is large, blue chip stocks that have succeeded and done well over many years and fulfill a number of these criteria already. Another option is instead of you buying actual shares, you rather buy into a dividend paying fund, a fund specifically set up for dividends. Now what this means is that there's going to be a professional fund manager who will then administrate and select which shares to put into this fund, into this bucket, so that you're able to get a good return. Now, historically, these dividend paying funds average about 3%. It is interesting to note that most dividend paying stocks that are healthy on the stock market have historically paid between 2 and 5%. So if you put in a little bit of effort and time, you can move yourself from getting a 3% annualized return to a 5% annualized return from the dividends. And this is the dividends only. It excludes any growth that might take place in your capital due to the share price increasing for that particular company or stock. We're now going to do an example using $10,000 invested in dividend paying stocks. We're going to take the high end of the historical average and say that you're able to achieve a 5% return, a dividend yield from your investment. We're also going to say that the stock increases over time by 6%, which is roughly the historic average of the stock market over the last 10 years. So if you bought $10,000 worth of stocks that pay dividends at 5%, each year you would get $500. Now that might be slightly disappointing because it doesn't amount to very much. At the end of 10 years, you would have shares worth $17,900. In other words, your shares have gone up from 10, your capital's increased from 10 to 17,900. And you are now getting a dividend of $890 or so at 5%. However, it is far more powerful to compound your money, And what this means is to take the dividends and reinvest it back into what you're buying. So you buy 10,000. At the end of year one, you receive your dividend of $500. You now put that back in and you have $10,500 plus about another $600 because the stock market's gone up by 6%. So you have $11,100. And so you continue that for 10 years. At the end of 10 years, instead of the $17,900, you now have $27,000. So almost $10,000 more, or actually $10,000 more. And your dividends are $1,350 per year instead of $890. So that is a very powerful concept, which means it's far better to invest now and grow that because it becomes quite significant even just over 10 years. If you did it over 20, the results are even better. What is the risks? Well, there's actually two risks. Number one is that there is a recession or something similar, in which case the share price probably will come down. Not only that, the company may stop paying dividends, in which case you will no longer be able to get the income. So if you're relying on the income from dividends to live off, you need to have a contingency or emergency fund to allow companies to have a time of up to a year recovering where they won't be paying dividends. Particularly bad was 2008 and 2009, where a number of companies didn't pay dividends for up to 2 years. So that is a very real risk that we need to consider. Not only that, if a company is paying too much dividends, what you will find is that they will continue to pay dividends and then all of a sudden be in real trouble because their payout has been too high. Remember that payout ratio of dividend per share divided by earnings per share? That was too high. And that means they used all the money to pay their shareholders as opposed to reinvesting back into the company. And so ultimately you end up holding a company that is worth less and less over time, and your capital may decrease in value and you may stop getting dividends altogether. I'm now going to link a video on how to start investing and beginner's guide to investing. So if that's interesting, please watch it. Remember to subscribe to the channel and share this video with someone else because together we can create an abundance.